Welcome to Investors Insights, episodes number 102 for the week of May the 4th. We're delighted to be with you. Today we'll be discussing some information in the markets that we feel like will be helpful to you. Just a reminder to follow us on Facebook, Twitter, and LinkedIn. Links are on our blog. Greg and Franklin and Bobby are out with client meetings this morning, having an extremely busy Monday, which is a good thing. We are very appreciative of that. Right. So let's get started.
I'm Greg Powell, and this is Investors Insights.
You're listening to Investors Insights with President and CEO Greg Powell and the Portfolio Strategy team at 5 Million Partners. Rolling 3, 2.
Trey, you're going to look at some from last week and some what's coming up this week, and then we're going to take folks through maybe a couple of back page headlines that we think later in the year may become impactful. So if you'll start with last week and kind of update us, it'd be great.
Sure thing. Kind of get to what we were discussing this morning. So last week was a very volatile week in the market. Thanks to a strong rally on Friday, the S&P ended down just under 50 basis points or 0.5%. That's not what we're looking for. It's not great, but the strong rally showed that we held some good support levels and brought us back above a very important 2,100 on the S&P 500. The main culprit was that GDP came out last Wednesday and Thursday, and that pushed the market down. What happened is the economy grew in the first quarter by only 0.2%.
Yeah, sort of tepid.
That's a pretty slow rate. That's below what we expected and what the market was expecting. However, it kind of did that last year at the beginning. So what's important now is we're going to be watching the upcoming data points and see if that low growth sustained or does it bounce back like it did last year. And so that's one of the things we're watching this week, which will be important, is the end of the week is the jobs number, and that'll be the first monthly jobs number of the second quarter. And so that'll indicate to us whether or not the economy's did it stall out or was it just a hiccup and then we can bounce back.
And sort of looking at that second quarter, that's a good day to see how we're going to come out of the chute. And you're right about that, it seems. Deja vu all over again. It was very much like that last year. Weather-related was part of it and some side issues internationally, and we've had that again this year. Same yet different.
Exactly.
But feels very different in a lot of ways, where the second quarter ended up being very good.
Yep, and earnings are still coming out, and we're watching those closely. Those have been those expectations were lowered, and those are actually exceeding expectations. So that should indicate to us that the economy isn't as bad as it looked, and that's kind of the things we're really watching to see if we're going to get the same but different as last year, the turnaround.
Yeah, interesting. And one thing Trey and I were talking about with the other guys over the last few days, we always like to give you sort of back of the page headlines, as Greg would say. Being back of the page eventually becomes front page later. And one we've been focusing on a little bit, in a good way, we'll say, is the rising level of corporate debt in the United States. They're out there being more active at historically low rates, borrowing, which means they're buying another company or starting another product, or they're building this new plant or whatever, and all that has a good multiplier effect across the economy. Also, too, consumers are doing that. They're becoming much more confident. You can tell coming out of, Trey and I were talking this morning, coming out of 2008, people were not borrowing much because the debt levels pre-2008, both corporately and individually, were really high. And as we went through 2008, people really got a little bit scarred by that psychologically because they didn't have the balance sheet strength or the income statement strength really to go out and borrow. So when you saw the Federal Reserve come in doing quantitative easing, it was an interesting phenomenon because all of a sudden rates were very cheap, but you weren't getting a ton of growth. Right. However, some of the data we're seeing now is showing that's becoming more normalized. Individuals are borrowing more for a trip to the beach, or they're borrowing for a child's education or for something at a store or remodeling a home or something like that because they're feeling more confident now, feeling more confident that they can do that because their jobs are good, their own balance sheets are good, their overall leverage is not as much. And corporations are doing the same, and that could have maybe a little bit of headwinds for the bond market perhaps, but it's overall, we feel like it's a great tailwind for the market because it is just finally some of that multiplier cash is getting into the system because the rates have been low, but now people are confident that they can move on.
Yeah, they're
from
using
2008.
those low rates
finally
to the benefit of the economy.
So that's something we wanted to have you focus on that maybe you may not have seen. And we find that very interesting. I think we latter part of this year, probably going into next year, that multiplier effect will start to get some traction. Do you agree?
I agree. So later in the year, we'll see that how that money is being invested into the economy after they borrow it, where is it spent, and then how that goes, and then how many times that can go around. You'd like to see the money changing hands to really get a sustainable growth rate.
Absolutely. Absolutely. Well, we appreciate, as we always do, all your questions and comments. I will tell you that feedback has greatly improved this, and we really do welcome that. We've gotten a lot of great suggestions, a lot of great questions. We love giving feedback from that. If you need Trey, me, Greg, Bobby, or Franklin, any of us this week, feel free to call us individually or email. We'll be glad to get back with you. And we hope you have a great week. Thanks.
More information at fiplanpartners.com. Securities offered through LPL Financial, member FINRA, SIPC.